Hi, and welcome to Macro Monday. We talk macro, trying to make sense of markets that really don't make any sense. And how can they when investors panic bid a $3,000 per share stock up as if it's going out of style? But more importantly, answer your questions so we can become better investors. I'm your host, now in widescreen, Steve Van Metre. Thanks for joining me today. Have I got a great episode for you today? So something I've been thinking about is the repo loans and how the 2009 financial crisis, when the repo loans ended, it sort of said, hey, stocks have bottomed now and the economy's starting to recover. And I've been thinking about that because I know things aren't better. It's very clear in the data that things aren't bottoming out and improving. Yeah, we have a fish hook, but as the June data starts to trickle in, and we're going to start seeing more of that this month, it's suspect that there's much of a recovery, unlike what we saw at the end of the great financial crisis. And then the answer, I realized, was right in front of my face. It's in the Fed data. So let's go take a look. Here's the Fed H.4.1, the Fed balance sheet. I was about to say H.8, which we will look at. And you come down here to the bill section. Well, let me show you first. Repurchase agreement 0 or 2. There's virtually no repurchase agreements out there. And if you're not familiar what a repurchase agreement is, it's where a commercial bank swaps treasury securities or mortgage-backed securities with the Fed for cash. They're short-term loans. Well, those loans have all but been paid off. So now the question is, all right, well, what's going on? Why is that liquidity problem fixed? Well, we can see it's right here. The banks have been demanding T-bills. And why? T-bills are a great source of collateral. So banks prefer to hold T-bills over. It's not that they don't want longer-term securities in terms of collateral, right? Think of that as if you were going to loan me your car, and you asked for some form of collateral, and I give you some obscure thing that might have value but doesn't have a big market for it, and I blow your car up somehow. I wreck it, damage it, it's destroyed, and you go to cash that collateral in, you might have a problem selling it because it's some obscure thing. Yeah, it might have value to the right person, but you don't know who they are. That's where T-bills come into play because they're 12-month and less maturity government debt. And just on a side note, in case you're wondering, a note and a bond do not become bills when their maturity is under 12 years. A note is a note is a note, and a bond is a bond is a bond, and they always will be. But a T-bill is 12-month maturity or less. And banks love that as collateral because they can sell it. The market's very liquid for them, extremely liquid. And let's just pretend it wasn't very liquid. For whatever reason, it just became somewhat illiquid. The bank could just wait until it matures. It's going to mature in 12 months or less, and they get their full value back. So it's a great source of collateral. And that was a mistake the Fed made back in March when they turned on that big QE vacuum. They were just buying up all kinds of T-bills. Well, they were buying everything, but they were buying lots of T-bills, and the banks literally needed them. Well, the Fed got smart, but what's interesting about this is all it's going to do is help those who are long-term U.S. government securities, such as this guy right here. So let's go back and say, all right, well, we now know the Fed is not buying T-bills. They haven't been buying T-bills. Their balance sheet on that's been pretty stacked. They've been buying notes and bonds, which is great. And that's interesting because when we look at the New York Fed's website, which shows the QE auctions, and they're not all every day, but they're almost every day. In the past, here's a perfect, didn't think there was one on here. It says 0 to 2.25 year maturity. They're not buying bills with this. They're only buying notes in this auction here. And a note could be anything that's a 2 year to 2.25 year maturity or less. Now, they technically can buy bills because it says 0 to 2.25%. They're just not buying any. All they're buying is notes, and then in the other auctions, they're also buying bonds. And this is great news if you're a long-term bond investor right now, because the Fed is effectively doing what with interest rates? Are they trying to make them go higher or lower? If you said lower, You got it right. QE actually causes interest rates to go lower. And I like to revisit this periodically because sometimes we have newer viewers or people kind of get confused by it. It's like, how can the Fed buying these notes and bonds through QE cause interest rates to go down? I thought it caused them to go up. No, it does not cause them to go up. Think of it this way. All QE is it's swapping on average 7-year maturity with a bank for cash. The problem is with the cash the banks receive, it's tied up in a Federal Reserve bank account where they can't withdraw it. So imagine I'm going to buy, say, something off of you. We'll say I'm going to buy your car. Let's say you have it paid off. I say, I'm going to buy your car. Instead of giving you money, I give you kind of a note that says, oh, by the way, you have some cash over here at this bank. And you go like, great, I think I'll go down and get it. And you go there and you can't get it. Or think of it like this, like a uniform gift to minors account. So let's say that you're a minor, you find out your parents have an account for you at the bank. And you've heard them, you weren't supposed to be listening, but you heard them say, yeah, when they, we're putting money aside for our kid, and someday it's going to get them, it's down at bank such and such. And so you go, well, cool, I'm going to go down to the bank and get me, a new pair of Oakleys or something. And you go down to the bank, and you go up to the teller and you say, hey, I'd like to withdraw my account. And they look up and say, well, we can verify your account and we can verify there's money in it, but you can't have it. Well, what do you mean I can't have it? Well, it's a uniform gift to minors. It doesn't transfer to you until you're 18, except this case with the money at the Fed, it never transfers back to the commercial banks. So how does that make interest rates go down? Well, it's real simple. When the large commercial banks have a treasury security, a bill, note, or bond, or a mortgage-backed security, whichever the Fed happens to be buying from at the time, what can they do with it to cause interest rates to go up? What could they do? How would they get interest rates to go up if they were sitting on trillions of dollars of treasury and mortgage-backed securities? They saw them, right? If the banks started flooding the market with security, with treasury securities and mortgage-backed securities, what would it cause interest rates to do? It would cause them to rise. But what happens when the banks don't have them to sell because the Fed's buying them from them and giving them a collateral account? Well, it causes yields to go down because the banks can't sell something they don't have anymore. And they can't dump that cash because the cash, they can't put their hands on it. So it's interesting to me that the repo problem went away, which normally, as I said, it signaled pretty much the end of the great financial crisis. Today, it is not signaling the end of what's going on in the economy. It's just so happened the Fed finally listened to the banks and said, okay, all right, we'll lay off buying the T-bills. And obviously there's plenty of demand for it because the Fed doesn't need to buy it. Meaning, if you are a long-term government bond investor or bullish on them like this guy, well, good news. You've got not only the large commercial banks buying them, you've got the Fed buying $80 billion a month of notes and bonds. In the past, some of that money went to bills. Now, appears to be none of it is going there. And speaking kind of what the large commercial banks are doing, if we go over to the H.8 data from that we looked at on Friday, I put some my calculator and pencil together, and what I noticed between May and June, the commercial banks bought $6 billion of mortgage-backed securities, and then they bought $121 billion of U.S. Treasuries for a total of $127 billion. Now, keep in mind, the Fed buys $120 billion a month. So on top of the Fed's $120 billion, the banks bought $127 billion. And between now June and the week ending July 8th, so 2 weeks into the month, the large commercial banks have sold $3 billion of mortgage-backed securities, and they bought $73 billion of U.S. Treasuries for a net total of $70 billion. And keep in mind, the Fed still buys $120 billion per month. The banks are on track. Now, of course, we don't know if they will actually continue at that pace for the remainder of the month. But the banks are at least on track at the moment to buy more bonds for the second month in a row than the Fed. And if that's not bond bullish, I don't know what is. Because the banks aren't buying these things to sell them. They're either buying them to flip to the Fed or they're buying them to hold as collateral. Great news if you're long treasuries. Let's take a look at the economic data. And there isn't really much to look at. And for those of you that have trouble seeing my screen, I made it a little bit bigger, and hopefully this helps. Now, I'm really interested in the June data. Now, the question is, why, Steve, are you interested in the June data? Because the global economy is reopened. Now, you've heard me say I don't really care about the May data. The global economy was starting to reopen, but in June it was open. We should see that mythical V-shaped recovery that everybody's predicting. If it's here, it should start showing up in the June data. And starting out Sunday evening, we have exports and imports out of Japan. Exports on a year-over-year basis for June in Japan missed expectations, fell 26.2% from last year, slightly better than last month of minus 28.3. So no recovery in exports in Japan. And guess where those things are usually, a lot of those things go? Around the world to consuming nations, such as the United States. How about imports? On a year-over-year basis for June, they improved from minus 26.2% last month to minus 14.4%. So imports did improve. However, they're still deeply negative, showing no V-shaped recovery out of the Japanese economy. And as we know, they have been in a recession. So how about moving into what other little data we have, because there's no U.S. data today to drive the markets. We have German PPI, Producer Price Index. This is prices coming out of the factory. So envision, a car rolling off the German assembly line on a year-over-year basis in June, improved slightly from minus 2.2% to minus 1.8%. So even in a month where we're supposed to see a global recovery, producer prices, while improved slightly, still remained in a deflationary pulse. Now coming up tonight, you can look and see what producer prices are coming out of South Korea. And then tomorrow morning, you've got Redbook weekly retail sales, which should be pretty interesting. At least I find it very interesting. Tomorrow night, you've got preliminary manufacturing and services PMI coming out of Japan. And then we'll be back on Wednesday to take a look at the mortgage market and what's going on in the housing market and the oil market. So very interesting stuff coming up that you can keep track of yourself. All you have to do is either go to investing.com. I know there's another website, or you can get the phone app from investing.com, and there's a little thing that gives you the calendar, the economic calendar, which is pretty cool. All right, let's go on and talk about what's going on in the markets. Take a look at a few things here. On today's list of things Steve finds amusing is how investors panic bid Amazon stock up as if it was going out of style. And this is very interesting because overall, from a market perspective, we didn't see a lot of volume, which suggests that given the move up, the sellers were just absent participants today. And look at the NASDAQ 100, probably one of the biggest up days it's had. I don't know historically where it falls, but it's a big up day and reached new all-time highs on no real news other than panic buying of tech stocks. So I'm very interested to see how that plays out going forward. With that, we come back to the S&P 500. It's staying above its upward trend line, still in a bullish mode here. And I said, as long as it stays over this line, which investors need to continue to defend, it is bullish. Taking a look at the Russell 2000, it's flirting with its upward trend line. What I find pretty interesting is we've seen volatility get absolutely crushed. And you have to think of volatility as a spring, or maybe like a rabbit. I mean, if you've ever seen a rabbit lay down, they're actually quite long, but they're just a big compressed spring when they hop, and it just goes. Well, volatility is the same way. You can compress volatility, but when you get no reaction out of it on the other side, i.e. rising stock prices, it tells you that you're kind of running to the end of how far that spring can compress. And remember, and a lot of people don't actually believe this, is quantitative easing leads to heightened volatility. You go, wow, that can't be. Well, where do you think this volatility came from in March? It started to go, and the Fed reacted with with a mountain of quantitative easing and shot it straight up. And so here we're seeing volatility compressed. most likely as computer algorithms or momentum programs continue to buy in this market, and they tend to as volatility falls. But in terms of what they're getting out of the upside of the market, for a 4.75% drop in the VIX, they got a less than 1% rise in equity prices. So granted, these are not one-to-one correlated, but they're still not getting that much upside for the downside move in volatility. In fact, that reminds me, we're supposed to go check out today the hedge fund position. So I'll get that loaded up, and we'll continue to go through the charts and come back to that. Looking at that large megaphone pattern on the S&P 500, so far appears to be intact. This would imply a massive bull market in the S&P 500 coming in equities. It doesn't make a lot of sense to me at all, because if we go look at the bond market, it tells the complete opposite's about to happen. If we look at 5-year treasury yields, they're flirting with this long trend line here, looking to break lower and drive 5-year yields to zero. You look at 10-year treasury yields, they're virtually same place they were on Friday, so they're unchanged, not showing higher rates. If equities were to be heading into this massive bull inflationary market, you should see yields rising. How about 30-year yields? Again, really didn't go anywhere from Friday either, suggesting that they're headed lower. And when we talk about yields, now let's go back to the Hedgeopia website. And let me get the browser flipped over here. And let's take a look at how hedge funds are positioned in the bond market. We're seeing the hedge funds are increasing their long positions on the 10-year. Now remember, you do not see yields bottom until hedge funds and other speculators are completely all in on the long side. They've got a ways to go, but this is just the beginning of potentially them getting up here, which would mark an exit point for those who are long bond market. How about the 30-year bond? They went even shorter, not by much, but they're sitting right near their second shortest position ever. So the hedge funds and other speculators, as of last Tuesday, are betting on a massive increase in treasury yields on the long bond, and they're not seeing it, which means when these get unwound and they still have to go long to see a bottom of the 30-year, this is just another reason why I still think it's possible. We may see 30-year yields go negative. It may only be for an hour or up to a couple of days, but it's possible between the hedge fund speculative positioning on the short side and the Fed, when they do their next big QE vacuum, this could drop 30 years negative. Could be very, very interesting. Let's continue on with how the hedge funds are positioned. They're still very long crude, which, given the increase in case count, does not make a lot of sense as we come out of the summer driving season. So now all of a sudden, all of these weekly crude inventory data will really, really matter. Looking at the S&P 500, they're still slightly short. And moving on to gold, which is trying to break out again. Everyone's now super bullish gold. Speculative positions haven't really changed, even though there's absolutely no sign of inflation, which means in a deflationary market, we could see a pretty strong pullback in gold, which would be validated based on what we saw in the great financial crisis. So if you feel you missed out on the gold or anything like that, don't worry. That deflationary shock that hit the markets and drove bond prices higher and interest rates lower in the great financial crisis was also bearish for metals and mining stocks, and it created a great entry point to confirm the major uptrend. As those sold off, you could buy in and still catch the upside of that. So I still think gold pulls back. I'm going to stick by that position for until I change my mind on it. NASDAQ 100, there's speculators still fairly long, not as long as they've ever been, but still fairly long tech stocks. Russell 2000, they've been slowly backing off their longs. And the dollar, they're short dollar. Everybody now needs to short the dollar. And if you look at gold, it's effectively mirroring the dollar lower. So if the dollar takes off, because there is a dollar shortage out there, we see the dollar rise and we see interest rates crash, it's going to totally upend the equity market and gold market simultaneously. And look at that. We're seeing volatility futures tick a little bit lower as investors and speculators take more short side of the VIX. And to me, this is just an absolutely risky play given the state of the economy. All right, let's go back to the charts. I want to look at what's going on with TLT here. And I've updated these lines here, and there's a reason why. I want to take you back again to what happened, and we visited this Friday, but I want to show you why this actually matters and what I did with these lines here. We know that when you're in a descending triangle pattern or you're breaking this sort of downward trending line, it's that second to the highest point where there's the most fight that's put up. And let's go zoom in here, and we'll draw some lines, and maybe need to back up just a little bit. So we'll make this, and we can draw a line here like that, and a line kind of like that, and you get what's called a pennant, or a crudely drawn one at this point in time. And a pennant is a continuation pattern. It's just, think of it as it's called a consolidation pattern, meaning that you see sellers selling inside this and you see buyers buying inside of it, and the buyers overwhelm the sellers and it causes prices to go up. Now let's zoom into where we are today, because we saw a similar break of this downward trending line, just like we did back then. And right at the second highest point, what happened? We see selling, selling, selling. So the sellers are defending. This is the strongest point of defense. Now let's zoom in, because like I said, I did update those lines, and you have what looks like a pennant. Now, if you're not sure what a pennant is, long time ago, and I remember when I was a kid, I had some of these on my wall. They're generally from colleges. They had pennants, and students would buy them and give them to their family members. I don't know if they still do that anymore. So to help those of you who don't know, I Googled it. And all I did is type in pennant pattern. Now you might have to type in pennant chart pattern. It just so happens that Google probably knows exactly what I mean when I type that in. And you go to the images and you get a bunch of different ones. And you can see that a pennant takes on this pattern here, where it comes up, hits its high point, then bounces in between a triangular pennant-shaped pattern, and then the breakout is when it goes above the higher line of the pennant. And it doesn't have to exactly hit the different points. These are just drawn that way. And you can scroll through here and see plenty of different examples of kind of how it works. And it's perfect because it is an example of what we're facing now. I'm kind of just looking in here to see if there's one that gives us a good, here's one from, of course, we can't see it because it's too small, but nevertheless, it shows where it doesn't touch the upper and bottom line. So let's go back to that charting pattern. So you can go look those up on your own if you're so inclined. And here's that pennant, and we can zoom out just a little bit maybe, and you can kind of see it forming. It's bouncing in between there. Now, what does this mean? Well, if this pattern is valid, now I should address the question of, why did you do that? Why did you change your lines? Were you wrong before? Good question. So when you do technical analysis and you're charting, you have to assume that you're not always right the first time. Charts do what's called morph. They can change. So you might have an opinion, okay, I think this is a pattern, and then it starts doing things that you're not sure about, and you can adjust your lines. That's totally cool. That is actually allowed in charting. I'm not cheating, but charting patterns morph, and this would morph into a pennant. Now, what that implies is if it breaks over this cayenne line on the top, that it would imply that this pennant is broken to the upside. And since it's generally a consolidation pattern, as we see by the flagpole rising and doing what it's doing here, we have to assume it's headed higher. We also can assume it's headed higher because who is buying? Large commercial banks and the Fed. And if they're buying, what does that do to interest rates? You got it. We already answered that question. It causes them to go lower. So, pretty interested there. Let's take a look at the dollar, because on one hand, you have bond prices rising, interest rates falling, and that is a tightening of financial conditions. And now you have everybody trying to sell the dollar. And there were some charts floating around saying the dollar's at this critical uptrend. And there's a couple different indexes of the dollar. I used symbol DXY. And here's the uptrend line going back from 2011. And the dollar can actually get down to 94 and be okay. Some people say this is a line in the sand. It can't get any lower than here. They might be drawing their chart pattern from down here. It could be. I mean, there's no right or wrong way to chart. And, well, the right way is if your chart's right. It's wrong if you're wrong. And there's only one way to find out is wait till things happen. So it's sitting at 95.8 or roughly 96 is not the end of the day for dollar. Everyone's saying it is. But you can see almost a perfect mirror move opposite in gold. I still think the dollar goes higher. And I think you get tightening patterns from that because, again, when the Fed does QE, it causes the dollar to go up in value and it causes interest rates to go down. You get double tightening, which is the worst of the worst. And the last thing you want is financial conditions to tighten on both sides. And you don't want the dollar to shoot up higher because you have a lot of foreign denominated dollar or foreign debts that are dollar denominated. I think that sounds a little better. And you don't want interest rates to collapse because falling interest rates are not inflationary until they are. They're a symptom of tight financial conditions until borrowers come into the market. We know that financial conditions are tight because these low rates are not leading to a growth in lending demand. That's why we look at that every Friday. All right, let's get to some of your questions. Now remember, the new rules on questions are I'm only taking the ones I find most interesting or that are highly on topic. First of all, thank you for the many free lessons on macro you're provided. Hey, you are super welcome. I haven't missed an episode since I discovered your channel a few months ago. Bravo. Guess what? I haven't either. Thanks for being here. I appreciate it. I'm curious to know your thoughts on the market cycles. I've talked to some people who believe this crash will eventually play out some of the 1929 and 1987 crashes. Look, 1987 was effectively a flash crash that turned around. 1929 was a depression. To me, they're completely different. My view is we are going to see a repeat of the Great Depression. Now, why is that? We have a lot of wealth of a small number of households tied up in stocks. That's very similar to 1929. You have an overheated, the economy is all built on speculation and too much debt. Again, these are all things that look like 1929. And unfortunately, due to the virus, now we have a lot of people on unemployment. Well, that looks like 1929. So I see we have a lot of things that are playing out very, very similar. We have a trade war. That kind of happened then too. So I think we're more likely to be a 1929 scenario. In 1987, we had a big drop, and then we were on the way on a bull market, completely different setups. The argument, as I understand, is that human behavior is more or less consistent. Therefore, one stock market crash will play out similarity to another. Do you believe that the current crash will mirror those from the past? Yes, I believe it will mirror 1929. How do trading algorithms, high-frequency traders, and other technological advances change this? Well, I can tell you, unlike probably the late 1920s, well, it could be similar 1920s, but we didn't have computer programs. Today, the U.S. stock market is effectively one gigantic momentum trade. Now, you might not know this if you're as your own investor, but when you go out into the financial services field, you find out there are annuity products, managed money products out there for people to invest in, and all kinds of other stuff, and derivatives. You have risk parity, asset allocation, you have volatility control products, you have all kinds of stuff out there. Now, whether this package is an annuity or a standalone product doesn't matter. What you have to understand is they are all effectively momentum-based products, meaning when stocks rise, they chase them higher. When volatility falls, they chase stocks higher. It's one massive momentum trade, and all these high-frequency trading programs and algorithms are all designed to push stocks higher. But guess what? If all of those programs flip from momentum buy to momentum sell, which they can, we've never seen, but they can, and you could think March was kind of a preview of that, well, then you could get momentum. If momentum shifts the other direction, I mean, you could just have selling on top of selling on top of selling, and it could exaggerate the down move, just like we've seen an exaggeration of the up move. Do you believe QE is affecting equities different than in past downturns? Well, there was only one downturn, really, we used QE. I mean, yes, there was QE back as some form of QE back in the Great Depression, but we can look back to the Great Financial Crisis, and no, I do not think it will affect it differently. I think the Fed will do another big round of QE that makes the last one look kind of smallish, and it will drive equity prices lower. I also love to get a brief summary of where you think we stand in general. With indices at or near their all-time highs, is there a scenario which they break above with room to run? Personally, I feel like I'm looking at some very irrational numbers. Look, the stock prices today are not validated by any form of fundamental analysis or company valuations. They're not. Can they go higher? Yes, they can. They can always go higher. Does it make sense? No, but I tell you what, watch the bond market, because when the bond market breaks, so like when the 30-year breaks below, say, 1.2, you're going to watch the stock market literally just puke all over itself again, because it's going to yank that liquidity. And if it drives the dollar higher with it, it's game over. Game over. Big fan of the show. Hey, thanks. I appreciate it. My question is about the Fed's latest chatter about letting inflation rise to 2%. This seems to go against your belief. Continue QE and yields dropping further. The Fed seems to be throwing their hands in the air, or is this simply posturing? Curious about your thoughts and implications if they actively pursue this path. It's a great question. And the problem is for the Fed is they can't get inflation up to 2%. Look, if they could get inflation up, then why are we persistently in deflationary or disinflation? Not deflation, disinflation since 1982. Why can't we just create inflation? It was so easy to do. So what the Fed is saying, and how it's being misinterpreted, is the Fed is saying if inflation gets above 2%, we're going to let it run above that for a little while. They didn't say we know how to get inflation up to 2% and we're going to get it up there and push it past 2% and you're going to feel the pain. Nope. All they're saying is if it gets there, it's not. So you don't have to worry about it. All the Fed is just saying is we're not going to do anything if that happens. They're hoping it does. It's not going to. Because quantitative easing and our monetary system are deflationary. They were not designed to create inflation. QE does not create inflation, and our monetary system does not allow for the Fed to print money. It cannot create inflation. If you have trouble with that, look back over 40 years and tell me why interest rates have been falling if we've had such high rates of inflation. Read the Federal Reserve Act. It says can't do it. Hi again, and thanks again for all that you do. Hey, you're welcome, and thanks for sending in another question. You probably answered this before, but can you explain how yield control curve would affect your thesis? Seems like the Fed is laying the groundwork for this. Yeah, I don't believe the Fed is going to do yield control yield. I think you just sent this question because I can't say those three words in a row. Yield control curve, or is it the other way around? Yield curve control. The question is are they going to do it to suppress yields, or are they going to do it to raise yields? Well, they don't need it to suppress yields because, well, banks are buying all the T-bills up without a problem. There's a demand for T-bills, so the Fed's not buying those. And the Fed's buying, notes and bonds to add liquidity. And you ask, well, why are they doing that? It's simple. Fed Chair Powell, well, he needs to do something to show he's doing something. I mean, that's important. But look, he wants to keep his job. And if President Trump wins re-election, he's going to go there and say, look, you can't fire me. I helped you get re-elected because I did all this QE. You fire me. Boy, the market's going to go sell off like crazy because they're going to lose faith. If Biden becomes president, he's going to go there effectively saying the same story, except in a different way. Look, I helped him lose, but if you go out and do a bunch of green bills or whatever stuff you guys want to do, I'll buy a bunch of that debt and I'll make you look like a hero. I'm sure he's got some spiel ready to go either way. So if it's to suppress yields, it doesn't seem to be an issue because yields aren't rising. If it's to raise yields because they're going to go negative, well, then either way I win. So if the Fed has to do yield curve control to drop rates to zero, which again, they're going to go there anyways, I win. And if they go negative enough, or the Fed has to do like Japan did, yield curve control to raise them up, I'm going to be out by then anyway. So I win. I like that. I win either way. I really like that. You mentioned many times that the Fed is and will continue to drive interest rates down by purchasing Treasury bonds, and this will eventually lead to a crush in the stock market. However, stock prices are an important indicator of sentiment, and a recession in the stock market could hurt how willing consumers are to spend. It will. It will absolutely do that. There's no question about it. Would it be possible then that the Fed would also purchase stocks in addition to bonds in the future, breaking the correlation between Treasury yields and stock prices? No, the Fed does not have the authority to purchase stocks. They'd have to be granted that by Congress, and to do that, they'd have to pretty much rewrite the Federal Reserve Act of 1937. I don't know why they'd spliced in that you could now start buying stocks. So no, the Fed can't buy stocks. Did it work for Japan? No. So why is it going to work here? See, if you go like, oh, well, if the Fed buys stocks, then I can take all the risk I want. Well, why didn't it work in Japan? Why is there something wrong with the Japanese stock market where when their central bank buys stocks, they don't go up? So why is it, oh, well, if the Fed does it, certainly now I can buy those high beta stocks and take all the risk. Simple answer is no, the Fed can't buy them. And two, there's no evidence anywhere in history that central banks can support asset prices. None. Because remember, it's an auction. You know, look, you ever turn on TV and see those car auctions on the weekends? I mean, it's just stream after stream of car. Well, what if the Fed came in early in the auction and said, we're going to buy up all of the cars, the next 100 cars. So they buy them, and we're going to pay extra for them. We don't care. We'll pay triple. Well, what about the rest of the cars? Remember, the market is a continuous auction. Just because one person buys it, overpays, what if there's no one there at the auction after the Fed's done? What happens to the values of those cars? They don't get bid up. There's no magic recipe for bidding up stock prices because every day there are buyers and every day there's somebody that also needs to do what? Sell. What are your thoughts on the secondary market corporate credit facility and the primary market corporate credit facility? The program is $750 billion. I understand that a special purpose vehicle, or as Steve calls it, trash can, is set up with the U.S. Treasury Department providing $75 billion in equity and the Fed lending the rest to the special purpose vehicle, with the purchasing of corporate bonds by the special purpose vehicle from mutual funds, pension funds, etc., equal to printing money, given that only $75 billion is provided by the U.S. Treasury. Thanks for your knowledge and answers in advance. The answer is yes. This is the grayest of gray areas the Fed has ever entered into money printing. This is the closest thing to it. Now, these bonds are not on the balance, are not going to stay on the balance sheet permanently like the U.S. Treasuries and mortgage-backed securities the Fed is buying. The way these things come out of the trash can or the special purpose vehicle is that someday they do get sold back. The Fed recovers their money. Again, I believe the Fed is doing this, and I've mentioned it before, to buffer all the corporate debt issuance due to the coronavirus. Whether or not it persists, it doesn't matter, but it does show that even though the Fed is buying them, it's not really propping up the high yield bond market as much as it could. Again, no evidence that this actually works, but in terms of answering your question that is this equate to money printing, it's darn near the closest thing we've had. But like I said, these bonds are supposed to eventually be sold back out into the market. So we'll see how that goes. I've got one other question, but I'm not prepared to answer it. It's about real yields and gold and whatnot. And I do mean to talk about that at some point, but I'm not quite prepared to do that today. So I appreciate you taking the time to watch. We'll be back on Wednesday to, again, take a look at the macro data, see, perhaps, keep an eye on the treasury yields or that TLT chart and see, do we break out of that pennant or below? Very, very interesting. I think we go higher and we see yields go lower, and then we start to threaten with an upending of the stock market. So it'll be very, very interesting to see how all that plays out. I'm Steve Van Metre. Thanks for watching. I'll see you Wednesday. Bye now. The content of this video is provides educational information only. Is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in the video that I'm going to do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.